Well, welcome everyone. My name is Andrea Tetier and I'm with Phipps Real Estate Group. I'm an investor-focused realtor and the team managing partner for anyone that doesn't know me. And this evening, we've got a few members of the Phipps team here with us as well. We've got Heather Fabris on the call. We've got Michael on the call here as well. And Sim is, I believe, on here also. So a few other of our team members joining us, and there may be a couple others that will be hopping in a little bit later. And then, of course, our speaker this evening, we're really excited to have Monique Verlaan here on the call with us. Monique is a CPA and an investor herself. She's also the co-founder and CFO of WealthShare REIT, and she's a Smith Manoeuvre Certified Professional, so has a ton of knowledge, and we're really, really excited to have her speaking with us on a bunch of different topics related to taxes. Of course, being an accountant, and it is that time of year, tax season, everyone's favorite time of year. But Monique's going to be sharing with us lots of different insights on a variety of different topics that I think are really important as investors that we're considering ahead of time before we're getting ourselves hopefully not into any problems, but doing some due diligence ahead of time, which is always really important. So Monique does have a presentation prepared, but there's also be lots of time for Q&A. So if there's questions that come up throughout, feel free to put them in the chat, and then we'll make sure that those are addressed and answered as we get going here. So Monique, I'm going to hand it off over to you.
All right, I'm just going to share my screen quickly. Just want to see if I can put that into presentation mode. There we go. All good. Can you see my screen?
Yeah.
Okay, fantastic. All right. Welcome, everyone. Tonight's discussion, we're going to be focusing on three key areas. Tax and regulatory aspects of short-term rentals, one of my favorite subjects, and I say that with absolute sarcasm. The tax advantages of investing through registered funds, and strategies for managing capital gains in real estate. We'll also look at how products like WealthShare Real Estate Trust can play a role in your overall investment strategy. But first, I always do with a bit of a quote because I want you to walk away with a better grasp of how to navigate taxes and regulations to make smart real estate investment decisions. So I am Alberta-based. I do apologize for those that are not. Success in Alberta real estate isn't just about buying property. It's about mastering tax strategy, leveraging registered funds, and turning market insights into smart investments. Andrea's already spoken about me. I'm not going to go into detail of this beautiful face. Yeah, right. But I do have a bit of a QR code there. If anybody wants to take a photo shot of that, that is access to my website. As Andrea said, I am a CPA CA, registered both here in Canada as well as in South Africa. I am the principal owner of Anker RETax, where we maximize wealth and minimize taxes. I'm a co-founder and CFO of WealthShare Group of companies. I'm also a trustee of a private REIT. And as Andrea mentioned, I'm a Smith Manoeuvre Certified Professional. With everything I do, I have to do a standard disclaimer. So we're sharing general insights tonight, but it's not tailored advice. Real estate and tax rules can be complex, and what works for one person may not work for another. Always double check strategies with your accountant or financial advisor before taking any action. The information tonight should serve as a foundation for your understanding, but professional advice is invaluable in your specific situation. So let's dive into my favorite subject, short-term rentals. It is a hot topic of late. So what we're going to be talking about is tax implications and GST considerations. So key point is GST. Unlike long-term rentals, which are exempt from GST, HST, short-term rentals are considered as a taxable service. So if you earn more than $30,000 from short-term rental in a 12-month period, you are required to register for GST, HST and charge it on your rental fees. And this is a critical threshold that everybody needs to remember. We also mention input tax credit, or as we call in the tax world, ITCs. Basically, once you're registered for GST, HST, you can also claim back any GST or HST that you paid on your expenses, which could help offset the GST that you had to pay on the rental income. Record keeping. I cannot reiterate record keeping more than enough. Without the records, you cannot substantiate your claims or deductions. One of the key misconceptions out there is, I don't need to keep records, or I don't only need to keep it for about 2 years. It's false. You, by law, under CRA regulations, you are required to keep your records for 7 years. They can actually reassess you going 7 years back, and if they find an anomaly 7 years back, they can open beyond 7 years. So it's imperative that you actually keep your records. So on the compliance side, federal and provincial regulations mainly refer to tax rules, like needing to register for GST, HST. The other thing what people forget about is they forget about the tourism levy. Tourism levy is also applicable on this as well. The other one that needs to be mentioned is local legislation, which involves cities and town requirements. For example, some cities require short-term rental licenses or permits, and there may be zoning restrictions, like not operating in certain residential areas. If you ignore these rules, you could face penalties or even lose the ability to claim certain tax deductions. So, best practice. Cannot mention it. Stay compliant. Get the proper licenses, follow the safety regulations, and keep all your paperwork. And since rules can change, a tax professional's advice can save you some serious costly mistakes. So this sets the stage for understanding how short-term rental operations can affect your taxes, especially when we later discuss selling such property, which I'll cover in the next slide. So let's go on to why I love short-term rentals. It's the GST impact on selling the short-term rentals. There are GST, HST implications when you sell a property that's been used for short-term rentals. Normally, when you sell a used residential home in Canada, the sale is exempt from GST, HST. You don't get charged, you don't need to charge GST to the buyer. However, there is an important exception that can catch hosts totally off guard. And that is regarding to a recent court ruling that took place. In August 2024, the Tax Court of Canada ruled that the sale of a condo, which had been rented on an Airbnb for short durations, was subject to GST. Why? Because by the time of the sale, that condo was not considered a residential complex under the tax law. So essentially, if a property is used primarily for short-term rentals, like stays under 30 or 60 days, typically like an Airbnb use, the CRA views it as being used in a commercial activity rather than as a residence. So when you sell it, the sale isn't exempt from residential sale. It's a taxable sale of commercial property. So this court case highlighted a few key factors. The owner had started using the unit almost exclusively for Airbnb in the period leading up to the sale. So the property's use had fundamentally changed from a long-term rental to a short-term rental. So as a result, the residential complex GST was not, the residential GST was lost. And the owner was on the hook for the GST on the sales price. So let's put it into context, because it is a significant cost. So, for example, 5% GST in Alberta or 13% GST in Ontario on the whole entire selling price. So this is a huge consideration for investors, because if you sold the property for $500,000 in Alberta, for example, at a 5% GST, that amounts to 25% extra that you now have to pay on the selling price that's owed to CRA. So, crucial. You need to plan ahead with this. It is important because there's serious implications. So if you operate a short-term rental and eventually decide to sell, you need to plan ahead. First, register for GST when required. Don't wait until you sell the property. Second, keep records of your rental usage, because if there were periods of long-term use, that could be relevant. Third, budget for the possibility of GST, HST. on the sale. This might mean adjusting your expected profits or at least being prepared so that it's not a shock to you. It may even influence your decision on whether to use a property for short-term rentals in the first place, especially in the final years before selling. And I'm always on this. Whenever anybody talks to me about, shall I turn it into a short-term rental? They know my answer straight away. Don't do it. So for buyers, there's a caution as well. If you're buying a property that was used as a short-term rental, ensure that the seller addresses the GST, HST correctly. Because it's not exempt, it's a taxable event. And the other thing is, as an investor, always consult your tax advisor or lawyer when selling such properties, so all properties handle the taxes correctly. The bottom line is that short-term rental operations can have long-term tax impact on you when you decide to sell. So knowledge and planning is absolutely critical. Let's go on to investing with your registered funds. Sorry, got a bit of a crackle. So how can you leverage your registered fund accounts like RSPs, TFSAs, RESPs, or even the newer first home savings accounts to invest in real estate or real estate related assets? The big advantage of these accounts is the tax sheltered growth. Investments inside an RSP or a TFSA grow without being taxed annually, which can significantly boost your returns over time due to compounding. For example, rental income or REIT distribution in a TFSA. So the tax deferral benefit is specifically an RRSP benefit. When you contribute to an RSP, you get a tax deduction upfront, which often leads to a nice tax refund. Or us real estate investors, we use it to minimize our taxes as much as possible. That money can then be invested in something like a real estate fund or a REIT. You'll pay tax later when you withdraw it, ideally when you're retirement age, because your tax rates are going to be a hell of a lot lower. Now, on a TFSA, on the other hand, it doesn't give you any upfront benefits, but everything that comes out, the contributions or the growth is tax-free. So both are powerful if used correctly. The other thing that needs to be cautioned about is contribution limits and eligibility. Always keep an eye on your contribution limits, especially on your RSP room and your TFSA limits. Over-contributing can cause penalties. And if you want to maximize contributions each year, you can, but be cautious of your contribution limits. Now, let's talk about a couple of tax planning status strategies. We mentioned direct and indirect vesting quite a lot. So direct investing means you use your funds to buy actual property, which generally can't be done directly inside an RSP or a TFSA. You'd have to withdraw it first. And except in certain cases like borrowing from your RST for a first home, indirect actually means using the funds to invest in real estate investment vehicle. One example is a real estate investment trust or REIT. Now, WealthShare Real Estate Trust is an example of a real estate trust that allows people to invest in real estate projects through units of a trust. You can hold such units in a self-directed RSP or a TFSA, which is a great way to get real estate exposure within a registered fund. So by doing so, any income or gains that the trust investment stay sheltered within the account. So the point of this slide actually encourages comparing the tax outcomes. For instance, if you buy a rental property outright with cash from withdrawing your RSP, you'll face tax on the withdrawal and then have rental income, which is taxable annually, and then eventually capital gains. Versus investing within an RSP, like in a REIT, where you don't get taxed yearly on the income or any gains unless you withdraw from that RSP. It's a complex decision and may involve factors beyond just tax, like control, liquidity, etc. But tax-wise, indirect investing through registered funds can be very efficient. Now, with regard to the tax implications on withdrawals, essentially when you need money from these accounts for the property, know the rules. RSP withdrawals, if not part of a home buyer's plan or a lifelong learning plan, are taxed as income and could also bump you into a higher tax bracket. There's also withholding tax at source, which people do not realize. if you actually withdraw, for argument's sake, $30,000 from your RSP, 30% is automatically withheld. So you need to factor that in if you are planning on using your RSPs for purposes of investing. TFSA withdrawals are a hell of a lot simpler. There's no tax at all. And you get the withdrawal room back the following year. So if someone plans to use, say, $50,000 from a TFSA for a rental property down payment, that's straightforward. There's no tax implications. Now, the same $50,000 from an RSP might net less after taxes unless done carefully. And if you're using the home buyer's plan for a first home purchase, which I'm trying to encourage my son, you have to repay the RSP withdrawal over 15 years or it gets taxed. So planning the withdrawal strategy is absolutely key. So let's talk about capital gains considerations. In this context, it actually means thinking about any tax hits when moving money out of investments to put into a real estate. So if your registered account is holding a successful stock or a REIT and you sell it to a fund to purchase property, in a TFSA, there's no capital gains tax. But in a non-registered account, there would be. And in an RSP, the concept of capital gains doesn't directly apply since everything is taxed on withdrawal as income. Also, if you're selling an investment property that was held within a registered plan, certain setups allow holding property in an RSP via a trust. The gains might be sheltered, but the key message is use the right account for the right purpose. And when you shift investments, do it the most tax efficient way. Often it might mean keeping the funds inside the registered plan and maybe leveraging them. Like some people use RSP qualified loans or mortgages. Or you withdraw, perhaps do it in a year when income is at your lowest to try and minimize the taxes. So in summary, registered funds can be a powerful tool for real estate investing if used correctly. And the slides that I've just presented is basically to encourage careful planning of contributions, understanding the investment options, direct versus indirect, being strategic about any withdrawals or reallocations for real estate purposes. And once again, I can't reiterate this, always consult with a financial planner or a tax advisor when using RSPs, TFSAs, or even first home savings accounts for large investments to avoid unintended tax consequences. So that brings up into the final section called capital gains. Oh, I love this section. And I also say that with sarcasm. So how does it work and how do you plan for them? Now, first, the fundamentals. And I get asked this quite a lot of times. Capital gain on a property is basically selling price minus your adjusted cost base minus selling expenses. So we in the accounting terms, we define that as ACB, adjusted cost base, because it's crucial when we do taxes. So it's not just what you originally paid, but also includes capital improvements. So if you bought a house for $300,000 and spent $50,000 on capital improvements, made an addition or whatever, your ACB is now $350,000. Simple example. Now, if you sell that property for $500,000 and you incur $20,000 worth of selling expenses, your gain is calculated $500,000 less $350,000 less $20,000, which equals $130,000. So out of that, 50% is taxable. So knowing these definitions help you keep receipts for improvements because they can save you on taxes later by raising your adjusted cost base. So any additions you've done, whether your primary home or rental income property, keep those darn receipts. It's important because it will help you reduce your capital gains tax on that property when you sell it. So the distinction between principal residence and investment property is one of the most important tax breaks in the Canadian real estate. If a property is your principal residence for every year you owned it, you can usually claim the principal residence exemption and pay zero capital gains tax when you sell it. And that's huge. But if you have a rental income property or a vacation property, for example, and it's not your primary home, you don't get that full exemption. In that case, as mentioned, 50% of the gain is taxable as at your income tax rate. So for investors, any sale of a rental property is going to have a tax cost. You need to plan for that. So one small note, if a property was partially your principal residence and partially a rental income property, or it changed its use from a primary to a rental or from a rental to a primary, there are proportionate rules, which we'll touch later on in the strategies. The other one is market fluctuations are a reminder that not all gains are in your control. If the market booms, you have a large gain, and that's a large tax bill. If it busts, you might have little to no gain, or even a capital loss, which in real estate you generally can't claim unless if it's a business inventory situation. The other thing is we can't control the market, but we can choose when to sell it to some extent. So that leads to some of the strategies that I was alluding to. Timing your sale can matter for tax. If you have flexibility, you might sell an investment property in a year you're not earning much income other than minimal income. And that way the taxable gain might be taxed at a lower tax rate. Or if you're selling multiple properties, for example, don't sell them all at the same time or sell them in the same calendar year. If you can help it, spread them out so that the gains don't stack against the higher income tax bracket. And that's what we mean by income smoothing. You've probably heard that a couple of times. So with regards to the principal residence exemption strategy, some investors there's a word I always struggle with, strategically move into a rental property to designate as their primary residence for a couple of years before selling, or they do it the other way around. There are CRA rules about change of use and one per family designation that can be quite complex. But the idea is to maximize the portion of time a property qualifies as your principal residence. So if you lived in a property part of the time and rented it out part of the time when you sell, you can often get a partial exemption for the lived-in years. So planning ahead and keeping track of where your official residence is each year will help maximize your tax-free gain. There's definitely an area to get advice because the rules can be very nuanced. For example, you'll probably hear words like deemed disposition rules when you change a property from a rental to a personal, or even from a personal to a rental income property. And finally, I want to touch on reinvestment and loss offsets. Unlike in the United States, Canada doesn't have a direct like-kind exchange, which the US calls a 1031 exchange, to defer real estate gains by buying another property. In Canada, when you sell and make a gain, you are going to be paying tax on that taxable portion, regardless of what you do with the money. However, if you happen to have investments that went south, in other words, you made losses, capital losses on it, selling those properties in the same year can actually offset those gains. And that's a common tax planning move, which we call Harvard losses to offset gains. Another tactic is simply holding onto the property longer. If you never sell, you never realize a gain. Though eventually somebody will sell it for you, even in your estate. Also, any costs you incur for the sale, like legal fees, realtor commissions, selling commissions, etc., and any remaining improvement costs should be documented because they will reduce your gain. I always encourage, it's a bit of a misnomer, but I do encourage, if it's really necessary, considering improvements before the sale, not just for boosting the sale price, but also because this could actually help with the cost base and it could lower your taxable gain at the time. So essentially, be strategic about managing your gains. Consider timing, look for offsets, plan for the tax so it doesn't derail your next investment. And before we go to Q&A, I just want to wrap up what we just spoke about. Just to summarize, navigating real estate investments in Alberta successfully requires a solid understanding of both tax regulations and investment strategies by properly managing short-term rentals, using registered funds wisely, and planning for capital gains. You can actually build a strong portfolio products like WealthShare Real Estate Trust can offer an attractive, professionally managed way to diversify your exposure while taking advantage of tax-sheltered growth. And most importantly, consult a tax or financial professional and stay updated with evolving regulations. I'm now happy to take any questions you may have.
Thank you so much, Monique. I know that was a lot of information, but a lot of really valuable information. So we do have a bit of time here for questions. If there's anything that you want Monique to go kind of back to or touch on further, or if you have any specific questions, then we can definitely dive into that a little bit here. Okay, so Jay's asking, if multiple properties are held in personal names and are sold with loss, can it be taken to offset for future property gains on other properties?
Yes. Yes, it will be. The nice thing about capital losses, you can carry it forward indefinitely, and you can actually carry it back a couple of years as well. So for example, I made a couple of capital gains a couple of years ago, and I had to pay tax on those capital gains, and I made a huge loss on one of my properties this year. I can actually take that loss and go back years to reduce that taxable gain and get a refund for what I paid. So you can carry it back a couple of years and you can carry it forward indefinitely. How's rental loss treated? Sorry, Jay, you need to say rental loss in the sense of a business rental loss or a rental property loss in the form of a capital gains.
Rental property loss.
Rental property loss. It's a business loss. There's no carryover balances. It just gets the nice thing about rental properties in your personal name and you making a tax loss on it, it actually reduces your income tax for that year. You can't carry it forward. It's actually utilized in the year that it's incurred.
Great. Okay, Edgar has a question on here as well.
Correct, you can't. When it comes to insurance, Edgar, whenever you claim insurance deduction for a rental income property, you just basically got insurance for the building. The tenant inside has got its own tenant, insurance. Now, when it comes to basement suites of individuals with basement suites, and you've got insurance coverage for your property, whenever you claim insurance deduction for the basement suite, you have to take the home contents out. So what you need to do is pull out your insurance policy, because your insurance policy will show you the premiums for everything. And you just look for the home contents and you find what the premium is and you reduce it from the balance. So let's say, for argument's sake, your insurance premium is $150 every month, of which $20 is home contents. You can only claim a prorated portion of $130, because the prorated portion is because of the basement suite. Make sense?
Great.
Trying to see if there's any more.
Yeah, any other questions? This is your chance for sure. We've got Monique here, and she's a wealth of knowledge. So if you have anything specific, feel free to put in the chat or unmute yourself.
I have a question.
Sure, Kelly,
It's
go ahead.
a hypothetical scenario. So if you have a primary property, you purchased it for say 300,000, it's probably worth 800,000 now. You're buying property at a higher value, but you're not quite ready to call the new property your primary residence. At what point do you pay the capital gains if you're retaining both properties? And do you have to pay, so that the $500,000 gain on your primary, would you be taxed at the 50% on that?
Primary, if you in your primary home, you do not pay any capital gains on the primary, purely because of the principal residence exemption. So as long as you've got your primary home and you've actually recorded it as your primary home, you will not be paying any form of capital gains. Primary homes is exempt, but you do need to declare it. So whenever you do sell your primary home, you still need to declare the capital gain, but automatically a principal residence exemption will be applied against it. Now, you could use another hypothetical situation to say, you know what, I've got a primary home and I've got a second home. And especially during the COVID time period, people, especially in Ontario, had homes by the lakes. And what they went and did was they moved out of the city and they went to the lake. and the lake property the cottage became their primary home, and their primary residence didn't, there it will be proportioned. So the homeowner has a decision to make, and they can make an election. They can make an election to say, my Toronto home is my primary home and my cottage remains my second home. If I sell the cottage, I will be subjected to 100%, will be subjected to capital gains. In other words, there's taxable gains to be had on that. But then my primary home will be tax-free. Or they can make a decision to say, I was at the cottage for 2 years. I've had that cottage now for 10 years. I actually used that cottage for 2 years of my time, and I'm now selling the cottage. Basically, 2 years of that 10 years will be exempt from capital gains. So it will be prorated. So only 80% of that property would be subjected to capital gains. 20% will be exempt because of the primary residence exemption. However, there is a caveat. You still got your primary home. So for 2 years of that primary home, it's a second home. So when you sell your primary home, only 8 of, let's say argument's sake again, you only had it for 10 years. Only 8 of those 10 years will be principal residence exemption applied, and 2 years will be subject to capital gains. And this is where planning comes in, because now you need to work out, whenever you do something like this, you want to try and maximize as possible that you don't pay as much tax. So you do a calculation to say, where am I going to get the most tax benefit of calling which one is my primary home? But you need to do that election. It has to be done at the time when you actually sell the property, because you can't all of a sudden decide after the fact going, you know what, I'm actually going to make this now my primary home. You should have done an election for that, because then you lose the benefit. So that's why it's very important. Whenever you do something like this and you've got second home, and I'm leaving rental income properties out of the equation here. Whenever you've got a second home or a primary property, always talk with a tax professional so that they can do a quick calculation. What is the most cost-effective or tax-effective way of working out which one am I going to be paying less capital gains on? And then you can actually make an election at the time when you do your return.
And is that just a standard CRA form?
Yeah, it's a T2091 form.
Thank you.
Did that answer your question, Joe? Oh, Kelly, sorry.
Yes, it did. It becomes very complicated, especially when the mortgage rules, because if you're borrowing an investment property and you declare it as a primary residence, then it automatically triggers that. So
that's something different. That's when the change of use comes into play.
okay.
So a lot of people do as well is they have a primary home and it's not their forever home, but they don't want to get rid of it either. So they see their forever home, they actually go buy their forever home, but they want to keep the original home and then they convert it into a rental income property. Now that is a change of use. And whenever there's a change of use, from a CRA perspective, it is deemed, they term it as a deemed disposition. So in other words, you've effectively sold it even though there is no third party involved. And that selling price is based on the fair market value. So whenever you do something like that, you need to get a fair market appraisal done to determine what is the value of that property at the time when you change it from a primary to a rental income property. Because then your tax calculation gets done. So for example, you bought it for $500,000 and you've now moved into your new primary home that you've just acquired, and you're now changing your primary home and the fair value is now $750,000. You've got a deemed capital gain of $250,000. But because it was your primary home up until that change of use, the principal residence exemption will come into play. So you're not going to be paying any capital gains on it. But the rental property value is now $750,000 because that's your new starting point. And if you sell it down the line for $800,000, you've made a capital gain of $50,000, $25,000 will be added into your taxable income. So that's a different scenario. So you've got a scenario where you've got a primary home and a cottage, and you've got a primary home that you're now changing the use thereof into a rental income property. And the same applies, Kelly, when you do it in reverse. And people do this sometimes where they had a primary home, bought another home, changed the primary into a rental income property, They didn't like where they bought their primary home after 2 years and decided, you know what, I actually preferred my original home, I'm moving back. You go through that same process again because now you're moving back into a rental income property, is now becoming your primary residence. So now you will be paying capital gains because you changed the use again. You've changed it from a primary to a rental, then from a rental back to a primary. So going from a primary to a rental, no tax consequences. Going from a rental back to a primary, there is tax consequences because it was an income property. So capital gains will be subjected to the differential between the fair market values.
Monique, is that something that you have to pay in that tax year, or can it be deferred if you're going from?
It can be deferred. But once again, you've got to do elections when you do that. As tax professionals, when we always ask the question, did you change the use? What did you do with it? Because we do now need to toggle it on the tax returns to say there was a change of use, and then automatically we have to file a T2091 form. And then it gets recorded and you can defer it. Ultimately, what's going to happen is coming back to that scenario with a cottage, for example. Let's say you have the property for 10 years. You lived in it for 5, you rented it for 2, and then you lived in it again for another 3, which means 8 out of the 10 years, you're going to have your principal resident exemption, and 2 years you're going to be subject to the capital gains. But it's going to be, this is where the fair market value appraisals is going to be a portion, because you don't want the number of years calculation, you want the actual calculation, because sometimes the actual calculation is actually more beneficial than doing it over the years approach.
So are those numbers, like if you sell it in year 7 of 10, is it the valuation at year 7 if it was your primary for?
So that's why I always recommend people to do fair market value appraisals, because there has been times, Kelly, where we have gone a situation during COVID. It's not so much here in Alberta, but in BC and in Toronto or in Ontario, where the market price has plummeted. So you want to try and benefit as much as possible from that.
Okay, thank you.
Thanks, Monique. So then there's a couple more questions. Andrew and Judah are asking.
Ed, I suggest you get hold of your insurance broker. They'll have the breakdown. If you can't see it in your policy documentation with all the premiums, get hold of your insurance broker. Okay, so my parents' property, they purchased a house in Surrey, BC during 1990, okay, which was their secondary rental, okay. Rex, you still basically deferring the inevitable. And in all honesty, there is a tax strategy where you can do a Section 85 rollover, but the thing is the rollover is at fair market value. And you have to get the equivalent number of shares for that value when you do it into a corporation. But if you sell that property within the corporation, bear in mind, this is passive income. It is not active business income, and you will be taxed at a higher personal tax rate. Would not be advisable to do that.
So what's the way that you would suggest in this case? Because it has gone down a lot. So if it was, because it was probably worth, like, it was bought for 200,000. I think it was worth like 2 point something million. Now it's back down to 1.5 or 1.3. So it's a good time to try to find a way to minimize the tax strategy.
Yeah, they can put it into a corporation, but bear in mind, as soon as you put it into a corporation, it's a lot more costly. The times when I recommend people to go into a corporation is when I look at the number of properties they hold and what their long-term strategy is. Your parents look like they're now basically approaching retirement age, which means they're going to be sitting at a lower tax bracket. So it's more beneficial them just basically doing it in their personal capacity than trying to do it in a corporation. Unless if the long-term goal is wealth creation and net worth creation, and that the kids become shareholders within that corporation to carry on with the rental income strategy, then it's worthwhile discussing that.
Okay.
But bear in mind that with the strategy, in such a situation, they're still going to be a shareholder within that corporation, and that share is still going to be worth X amount. And if something happens to them, the estate is still going to be paying tax on it. It doesn't get passed. The inevitability is still there. They're not going to get around it. It's just they are deferring it down the line.
Okay, so let's say like the tax from the time it was purchased to now, right, which has gone down, and let's say the property appreciates again, back to COVID levels, that gain, will that be taxed at the corporate level, which is I think 13%, or will that be
No, that's active business income. Corporate tax can be 50%.
Oh, okay.
So
Oh,
this is what people don't realize when when they invest in corporations. And that's where you always have to discuss with the client of what is the long-term goals. Because everybody thinks, you know what, I'm just going to put in a corporation because I'm trying to circumnavigate the tax situation in my personal capacity. But what people don't realize is residential income properties are passive in nature. It's not active business income. It is passive. So which means you do not get the benefit of the small business deduction, at which means the first $500,000 is always taxed at the lowest corporate tax rate. And then anything over and above it is taxed at the corporate tax rate. That could amount to 50%. So if all your income in that property is rental, it is passive in nature, which means you're going to be paying 50%. If your personal tax rate is 36%, I'd rather pay 36% than 50%.
There's no profit to be made in BC. It's just capital gains. There's no rental profits to be made.
Yeah, correct. Well, a big to differ. From a cash flow point of view, I agree with you. You guys are net cash flow negative. There's no doubt about it. But from a tax perspective, because the principal payment of the mortgage is not tax deductible, only the interest component is tax deductible, you could still be in a tax liability position on a rental income.
There's no mortgage. I don't think there's been a mortgage.
Is there no mortgage?
No mortgage.
Oh, well, if there's no mortgage, they've got no interest to write off. So they're sitting in a tax position, on a taxable income position on those rental income properties. I would relook at mortgaging. But be careful when you do that as well, because if you pull money out and you use it for personal use, that mortgage inadvertently becomes non-tax deductible, which you don't want either.
Yeah, so the goal is we do want to expand, but we're just not sure. So that's why we're asking.
If you want to expand, why don't you refinance that property, mortgage it, because it's to your tax advantage, use the equity in that and go and buy yourself another rental income property.
Okay.
I mean, goodness, if I was in your position, I'd be having a field day.
Okay. Well, we don't really know as is. We want to learn first before we take on all that debt. So,
For sure.
Okay.
And Rex, maybe if it's something of interest too, I mean, it might be something, consult with Monique to dive into that further. Might be a good idea as well.
Okay. Oh, one question is how do real estate investors, make money then if there's all this tax and all this burden and after so long, it's like then it takes so long to appreciate and then you finally make this like few $100,000 or whatever $1 million gain after like 20 years. What are the corporations doing in order to get around that? Because I'm sure at 50% they're not making no money.
It stays within the corporation and we just keep reinvesting.
Oh, okay. And then so they find a way somehow like
put it this way, Rex, there's ways and means, and I'm happy to take this offline.
Okay.
There's ways and means around it. We all as real estate investors know the tricks of the trade, don't we, guys?
Okay.
Yeah, absolutely. Yeah. And we'll put Monique's information again in the chat too. So if you do want to plan, book a consult or, dive into some things a little bit deeper with her to look at specific scenarios, then can definitely do that.
Okay. Ed must be having serious heartache with insurance. Ed, talk to me. What's the problem?
Hello, guys. The question regarding the home content, I will call the insurance broker and I'll ask. In one of my policies, I found fees and searching in internet and AI. Some of them were saying that I can deduct the fees, like a policy fee, insurance policy fee. Some of them saying no. The question is,
if it's for personal if the insurance policy is for personal use, the answer is no, you can't actually claim those fees. But if you're actually using it for investment purposes and it's actually designated for that investment, like a real estate investment, then yes, it is tax deductible.
Okay,
The only
thank
thing you
you.
can't do, and I know where you're getting, because I know you were thinking of the basement suite,
Yeah,
that it's prorated. It will be
okay, yeah, I will
really
allocate the
because, yeah.
percentage. Yeah. Okay, cool. Thank you. And one more question, very fast. The last one regarding like if I bought the fire extinguishers for the rental property, can I deduct that as well?
Yep.
Is
It's an expense you can write off in the year that you bought it.
it a capital?
No.
Current. Okay, cool.
Yeah.
Thank you.
Right.
I think we had missed one question up here from Andrew and Judeline. It was, is it possible to pay the RSP tax years ahead before retirement?
No. It's always taxed on the day, the year that you actually withdrew it. You can't do it ahead of schedule. Unfortunately not. Although CRA would love you to prepay, but when it comes to the time when you actually withdraw the funds, then they'll take whatever you prepaid into consideration and then top up more because it's based on whatever your tax rate is in that year. The main thing is, folks, don't give more money than what's due. Right. Please go ahead, ask. All right. So yeah, I get asked this a lot, Rex. And funny enough, whoever subscribes to my newsletter, I'm coming out with a newsletter on this particular subject of what is a repair and what is a capital cost. So please go to my website, subscribe to the newsletter, and I'll be providing putting in layman's terms with a bit of humor of exactly what is the difference between repairs and capital cost.
That's great. Is that the best way for everyone to reach out to you then, Monique, is through the website?
Yeah, if they want to, or they can actually, I'll just put my, I'll just put the email here.
They've posted the website in the chat there for anyone, and then Monique.
I'll just put the email there as well.
Great. Any other questions? Got just a couple of minutes left here. If there is anything else that you wanted further information or clarification on.
Just a quick question, Monique. Do you also practice in US as well? Do you know that part? Because I heard you said about 1031 and rollover and stuff.
I'm planning on going that way, Hamid. Not this year, but I hope to be able to do US taxes next year.
Thank you.
Gosh, I thought I'd get a lot of questions. No way in hell that my slides answer everybody's questions. Come on.
Unfortunately, personally, I joined a bit later, so I missed the first part, and I don't know if we have any recording or any way that I can be there. That's why I don't have much of a question other than the last part in the state.
No problem. We will have the recording and it'll be posted up on our YouTube channel. So you'll definitely be able to rewatch back.
Thank you.
Hold on. Rex, you saying, I mean, do people make the repairs themselves through affiliate company or their own? Are you talking about repairs and maintenance to rental income properties? I've got to be honest, there's some that I do personally myself, but I have limitations and I get a vendor in to do some of the repairs. My labor is not tax deductible, but the parts that I bought is tax deductible. And if I use a third party to do repairs in the rental income property, that's tax deductible. It's repairs incurred in the year that it's tax deducted in the year that it's incurred. The only time where repairs is not a repair is, for example, if you do a renovation. You go in, you bought yourself a rental income property, and you're now going to make some changes. So in other words, you're painting out the whole house. You've taken out the floors, you've replaced the floors. You've gone into the kitchen, you've taken out the kitchen doors and you put new doors on. That is all considered as a capital cost. That will be added to the purchase price of your home, and that will reduce your taxable capital gain. But repairs and maintenance, so for example, you got somebody in to maintain the furnace, or you had a furnace issue, that is a repair. That gets deducted off your rental income for the year that it was incurred. So there's a differentiation between a capital cost and a repair.
Okay. And then, so do some people just, if they do it themselves, they just shoot up the cost on their own on their renovation or whatever? Let's say they're just doing the hardwood floor, and then with the trades, they just put in a higher number so that their capital gains burden is low, like in BC.
Yeah.
Because
So for example, you're replacing the floors. If you do it yourself, you can't charge the labor. Okay.
Okay.
The owner, you are putting in the floors. So whatever the floors cost you from the supplier, that will be added to your taxable adjusted cost base. In other words, purchase price plus whatever the cost of the floors were. Now, if you're using somebody to do it, a contractor to put the floors in, then the contractor's rate, his whole invoice for that matter, then gets added on to the cost.
Okay.
So there is advantages of yourself, and there's also advantages having a third party do it.
Okay. And what if like you just start like a company yourself? And that would be considered
you've got to
a
be
third
careful
party.
with that because if you start doing that, it needs to be what you call it, arm's length. Soon as CRA determines that there's a related party, then they start looking into you. And what you want to do is be above the radar line. You want to be below the radar line.
Okay.
I know there's a lot of people that's trying to be ingenious. And if CRA determines that that is tax avoidance, trust me, you are going to be flagged, and you'll be flagged for a long time.
Okay.
And even if you cool and you clean for 2 years, you remain flagged. You do not want to be flagged.
A quick question. And the tools that were bought to make the capital gains repairs, they can be deducted as a capital expenses, right? Sorry, is the capital?
You've got to be careful on that one now. If you've got a rental income property and you bought yourself a compressor because you want to spray paint the walls, okay, the paint itself can be tax deductible, but the compressor won't. Unless if that compressor is dedicated to that property, then you can actually add it on to the capital cost to that property. But bear in mind, you need to sell that property with that compressor. Okay, so if you're planning on keeping that compressor and you want to use it for other rental income properties, no, you cannot add it to the capital cost of the property. It is now your personal tool, your equipment that you're going to be using. But the stuff that you buy for that compressor to be used, that can be written off because you're now using that particular, the paint, the thinners, you're now using that for that dedicated property, that can be written off against that property.
As a capital expense?
No.
As a current?
If you're just doing a room, so for example, Edgar, if you just, you bought a rental income property and you've got about 10 rooms in there, including bathrooms, bedrooms, and kitchens. And of the 10 rooms, 3 rooms actually need to be painted. The cost of those 3 rooms to be painted is considered as a repair. Okay. You're not doing the whole house. You're only doing certain sections. Then you can actually write it off as a repair and maintenance.
But if it's the whole house,
if it's the whole house, it could be considered, because the argument they're using is you're prolonging the life of the house.
Yeah.
And because you're prolonging it, it's considered as capital, and therefore it's added to the cost of the house. So you can't claim it as an expense deduction, but you can claim it as part of your ACB deduction.
And all tools that were related to all these repairs will be as a capital.
Is your personal, unless if you're going to be selling it with that house.
Even like not the whole compressor, but the paint.
The paint is not tools. Paint is basically the what you call it, the supply.
Okay.
The supply itself, that can be.
Okay, I understand. Thank you.
All right. Any other questions, folks? Yeah, I think that's it, Andrea.
Wonderful. Well, thank you so much, Monique. That was a lot of knowledge and information packed into the past hour. So thank you for your time. And that for anyone, again, if you have any specific questions or you're looking for a investor-focused accountant, Monique is so wonderful. Take a look through her website, reach out through email. I know she'd be happy to connect further. Any final questions or notes or anything else you want to end on, Monique?
No, that's it. It was nice chatting with you all tonight. Thank you.
Wonderful. Thank you so much for joining, everyone. This, again, it was recorded, so we'll be posting on our YouTube channel within the next couple of days here if you want to go back and look at the information again.
Thank you so much. Have a lovely evening.
You
You
too,
too.
Leah. Thanks for joining.
Thank you. Thank you,
Bye,
Monique.
everyone. You're welcome. Bye.
Thank you. Bye.